So in my previous videos, we've already touched on looking at self-employment tax. We've been looking at limited companies, the pros and cons of both, and also the taxes and the difference in the taxes that you'll pay between those two structures. In this particular video, we're going to be looking at self-employment taxes, and specifically, we're going to be looking at maximizing your deductions, making sure you're getting the most for your money, paying as little tax as you need to, and maximizing the money that you'll be retaining. So this first section is going to be looking at what actually qualifies as a business expense. Now this is really important that you make sure that you're getting maximising deductions as possible, because you don't want to be paying tax on things that you shouldn't need to pay tax on. The first thing, and one of the most important things, is that you can make deductions on your income for things that are wholly and purposely purchased. The first thing to note is that you can make deductions off your income for any expenditure that you make that is used wholly for the purpose of your business. Now this can be a range of things, and some examples would be such as office supplies, marketing, HR costs, IT equipment, legal and professional fees, rent and utilities, insurance, and any other subscriptions that you make as part of your business that you require to be able to function. Now those costs are really easy because you know that you're going to be using them 100% for the purpose of the business, and if the business didn't exist, you perhaps wouldn't need to be making those costs. There are some costs, however, that will have dual purpose function. Those things will be such as using a mobile phone, using your car, using a laptop, where you may use these for your business, but you may also use these for your home life and personal life outside of your business. Now for these, you can still make deductions, but you must make the deductions in the portion of your business expense only. So an example of this is the purchase of your mobile phone. When you purchase a mobile phone, you should decide how much of your day is going to be spent using it for business purposes and how much will be spent for personal purposes. Based on that calculation, you can make deductions for that. You'll also be able to itemise your costs and any calls and texts that you make off your mobile phone, and that will be able to help you distinguish between how much of it is personal and how much is business, and therefore deductible from your taxes. Things like cars are a bit different. You are able to claim business mileage for any travel that you make for the purpose of your business, and you can do so at 45 pence per mile up to the first 10,000 miles, and then it's 20p thereafter. Again, with things like internet, you may use your business for at home, and you may do so using the internet, and in order to do so, you may want to track your time and usage of your internet spent for the purpose of your business, and therefore you can make an allowable deduction for that. And finally, one of the most important things that people actually forget is utilities, your heating, your electric, your water bills. If your business is at your house, you can therefore make an allowable deduction against your business for the business expense and apportion that accordingly. What I really want to go through now is some of the things that HMRC will specifically look at, and some of the things that you should be wary of when making allowable deductions against your tax. One of the first things is where you've got low income and then you've perhaps got a really high expenditure. Often that will result in you making a loss, and HMRC may want to investigate that. Also, claiming 100% of your car allowance as business. Now this is highly unlikely unless you've got a van, which you may use solely for the purpose of business, but even then, you're still likely to be making some personal trips in that vehicle. So it's very risky to claim 100% of your vehicle mileage as business use. There's also large and frequent cash transactions. If you find yourself in a position on your bank statement where you're depositing large sums of cash or withdrawing large sums of cash, HMRC may want to investigate this. Additionally, where your office is at your home and you're reporting high portions of your costs for your home, things such as utilities, as business, they may want to investigate this, because unless you're spending 24 hours on your business all times of the year, it's very unlikely that will be the case, and they may be thinking that you're overstating your deductions from your tax and therefore underpaying tax. Another one that we've not mentioned before is actually foreign travel, where you're completing foreign travel and there isn't the valid justification that it's solely for the purposes of business, therefore they may want to investigate that. And finally, one of the ones where it's less clear cut is purchasing personal items and claiming on the business, such as laptops and phones. Often people will claim that these are 100% used for the purpose of their business, when actually that may not be the case, especially if they've only got one phone and one laptop, and in most cases they'll be used for dual purposes in their personal life as well. In terms of record keeping, you need to keep your record for 5 years after the 31st of January following the tax year where you're making the expense. Examples of this sort of evidence will be receipts and invoices for your purchase that you made. It'll also be receipts for your fuel and itemised travel expenses where you've completed business mileage in your vehicle. Things such as phones and utility bills where they're annotated to apportion them to what percentage is going to be business, and what percentage is personal use. Travel with itineraries and purposefully dictated in terms of which bit was relating to the business. And also bank statements. It's really important that you keep bank statement copies because they're a trail and evidence of the expenditure that you've incurred over the previous years. And if HMRC want to investigate you in future years, it's really important you've got all this evidence available and you've got it pre-annotated, so you haven't got to think back many years when they ask questions. There are also so many ways that you can record this information, such as using QuickBooks or Xero as examples, but there are also ways on your phone like taking photos, keeping those photos in certain folders for certain months and years, and it's a really good way to be able to track your expenditure and keep that evidence in a digital form as well as a physical form. So part 2 of this video is actually going to be looking at your home expenditure. I've touched on briefly the fact that you can claim some of your utilities where they're used for business, for example where you use your business and you complete business from your home. Now HMRC offer you 2 methods here. There's a simplified approach which offers you a flat fee to make allowable deductions based on the amount of hours that you spend in your home for work purposes. If you spend 25 to 50 hours per month, you get a flat rate of £10. If it's 51 to 100, you get £18. And if it's 101 hours plus, you get £26. Again, it's really important that you can only make this claim if you're self-employed and not if you're trading for a limited company. Most people won't use the flat rate. And the reason for that is because it can be way disproportionate to the actual expenditure that you've incurred that you wish to deduct. So most people use the actual method, which is what I've touched on briefly before in terms of apportioning your costs to your business life, so therefore you can make the deductions in time. Some of the key home ones you can actually include mortgages or rent apportioned. You can include utilities, council tax and insurance if you're using your business from your home. So one of the ways you calculate this is based on the number of rooms in your house. If you use one of 5 rooms in your house for business purposes and you're in there for 50% of the time, therefore you'll be allowed a 10% deduction. And there's also a time-based one where you calculate how many hours you're spent in that room over the day, and then you apportion that over the square footage of your property and you multiply that percentage by your expenditure that you've incurred. So what I'm going to do now is I'm going to show you an example of someone who uses the actual cost and someone who uses the flat rate and the variance between the two, so you can see which one may be more suited to yourself. So if we use an example, we're using Sarah as a freelance designer. She works 35 hours per week, which is 140 hours per month. She lives in a 3-bedroom house, 5 rooms in total when you include things like kitchens and living rooms. Her monthly expenses are as follows: rent at £1,200, utilities at £150, council tax at £150 and broadband at £40. Option 1, using the simplified, is because she goes over the hours. Option 1 is because she uses over the total hours of 101 hours per month. She can claim £26 per month, which is £312 per year. Option number 2 is that she can apportion 1 room out of the 5 for business use, if that's what she does. She assumes that she's going to be using that for 70% of the time for her work, and therefore the calculation for this is £1,540 of her total expenses. You apportion that 1/5 for the rooms and 70% of the time, which is 14%. So her allowable monthly cost is actually £215.60, so her allowable claim is £2,587.20, and you can see here it's a significant more deduction. That's why most people will use the actual costings here. And you'll see here over £2,000 per more. In terms of some of the common pitfalls to actually watch out for, is the fact that if you're using your home and using it exclusively for business, it may affect your private residence relief when you're coming to sell. This basically may mean that you might have capital gains tax problems where you're making a gain on your property, and therefore you may have to pay additional taxes for that. And in terms of which one you should actually use here, if you've got a simple setup and you're low hours and work from home, use a simplified approach. If you've got high household costs and you use regular hours at your house for business, use actual costs. Most people in these circumstances will use actual costs because you'll generally get a higher benefit from using actual costs. The next part of this is going to be looking at travel, meals and entertaining of clients and guests. This is often one of the most misunderstood expense categories for deductions off your income tax. So some of the allowable expenditure includes business trips and work trips for visiting clients and customers. It also includes business mileage, which we touched on previously, at 45p per mile for the first 10,000 miles and then 25p thereafter. And it also includes things such as parking and tolls. Non-allowable expenditure includes things such as your ordinary commute to your workplace and travel between home and your regular workplace. Now the HMRC rules on client entertaining varies all the time. It's really important that you do research online to check what the current rules and guidelines are. And again, making sure you're keeping all of your receipts or your allowable expenditure So when HMRC asks for this evidence upon submission of your self-assessment tax return, you have all of the information available for them. So the next section of this is going to be looking at equipment, software, and professional development deductions. Equipment purchases such as phones, computers, and furniture are all allowable deductions, and if you're using them for your personal life as well, you must make the relevant portions of your business expenditure and deduct that portion only. There's something called the AIA, which is the Annual Investment Allowance. This allows up to 1 million of capital expenditure to be deducted from your income tax. In terms of who can claim this, this is available for sole traders, limited companies, and partnership, but there is set criteria in terms of what expenditure is allowable within this, and therefore it's really important that you check up on the HMRC guidelines to understand what expenditure is allowable and making sure you're making the correct deductions. The purpose of this is to enable 100% deduction from your tax for qualifying purchases in that tax year. You can claim the annual investment allowance often on most plant and machinery, and examples of this include office equipment such as printers, desks, computers, tools and machinery for construction, business vehicles purchased through the business and as a commercial vehicle such as vans, lorries and trucks, fixtures and fittings such as CCTV, shelving, air conditioning for your business, and finally integral business features such as lifts and heating and ventilating systems. Some of the things that you can't include in this at 100% deduction include cars, land and buildings, and things that have been gifted to your business from somebody else. An example of this might be that someone purchased tools for their construction company at £75,000. They make £75,000 in income in profit, and therefore they can deduct that 100%, and they would therefore make zero profit for the year and would therefore pay zero tax on that income. There's no need to spread this tax over future years. You get 100% relief straight away in that tax year. The annual investment allowance is given over a 12-month period in your accounting period. So if you have a shorter accounting period or a longer accounting period, you must apportion that million over the months of your accounting period. Some of the key strategic tips that I would give you would be purchasing these capital assets before the end of the financial year in order to save tax if you're going to be purchasing it after the financial year anyway. Stagger larger purchases within the annual investment allowance limits. So if you're about to go over your 1 million limit, avoid making the purchase until the following accounting year. And combining the annual investment allowance with other deductions such as the first year allowance, which you may want to read up on the HMRC guidelines. And again, finally, in terms of record keeping, it's really important that you keep record of all of your invoices, bank statements, documentation of purchases, to show HMRC when you purchased it and how it qualifies as a qualifying capital purchase under the annual investment allowance. And finally, I want to go over some of the legal and documentation side. If you've got no receipt, there's no allowable deduction, and it's really important for that. If you get investigated and you haven't got a receipt for your purchase, they will ask for that tax to be repaid, and you will likely incur both interest on that tax and fines and penalties in addition to that. You must keep your records for 5 years subsequent to the filing deadline on the 31st of January in which you're making the claim. Digital records are acceptable, such as photos, which I've touched on before in terms of how you can keep records of these on both accounting systems and also on your personal and business laptops and phones. What I would do is I would advise having monthly folders and categorising these by the expenditure you're purchasing. This will be a quick and easy way in order to find information as and when you need it. Also, make sure you keep bank statements as a record and a backup for your evidence of the purchase. And finally, what I would say is find a system that works for you. Purchasing the asset should be the most difficult item. Recording and keeping the receipts and relevant information should be one of the easiest things. So try and make it as quick as possible, because whilst you're busy with your business life, you don't really want to be thinking about the admin. So if you can make it a job that's 5 minutes per week, that will really benefit you in the long term.